Wall Street is expecting a 50 basis point rate hike at the Federal Reserve's next policy meeting in May. However, Citi is making a pretty provocative call, now saying that they think the Fed will hike rates by 50 basis points 4 times in a row at consecutive meetings in May, June, July, and September, suggesting that the Fed is not currently being aggressive enough and is woefully behind the curve in fighting inflation. Joining us right now is one of the authors of that note, Veronica Clark. She's an economist at Citi. And Veronica, are you thinking that the Fed is woefully behind, or are you thinking that the Fed is changing its thinking and is going to start making up some ground pretty rapidly here?
Yeah, I mean, this really does come down to just what we think inflation is going to look like. So I think the market has come to expect the 50 basis points in May. And we're really not seeing any signs that, inflation data after that May meeting is going to slow down in any material way. We have new supply chain disruptions, of course, commodity prices that are rising. So really, if you're doing 50 in May, and we've heard from Fed speakers over the last 2 weeks that they're open to 50, why would you slow down at that point? So it just seemed most likely to us that they keep moving at that 50 basis point clip.
Maybe the one thing preventing the Fed from signaling anything like that at this point is that they want to wait and see not only what the inflation numbers bring, but how the market reacts to this and how the economy continues to develop. By just about every account, the economy is really motoring right along right now. Even Janet Yellen told us on Friday on the program that she doesn't see any signs of weakness anywhere. However, if the Fed starts to raise rates, if these higher energy costs, if this inflation continues, I guess the expectation is that it could hurt the economy at some point, and maybe they'd be a little less willing to move so decisively in the face of that.
Yeah, I mean, we would agree that we really don't see any risk to growth for the near term, the next 6 months or so. Of course, market indicators, the flatness of the yield curve is maybe a little bit worrisome. But if we look at the economic data that tend to lead recessions, things like the ISM surveys or initial jobless claims, everything's still pointing to a lot of strength out there, especially in the labor market. But we could definitely see, a slowing later in the year. But I would note that, that's a little bit intentional, maybe a lot bit intentional. What policy needs to do right now is lean against demand that is too strong, relative to supply.
If the Fed does what you are now predicting, this huge number of hikes that you're calling for relative to what we've been anticipating to this point, do you think it changes the inflation picture? Does it start to address that?
Yeah. I mean, I think that is the hope, and that's what's in our forecast pretty much. And I think that's, what the Fed is certainly hoping for. So we do have 50 basis points at the next 4 meetings. That gets you to the long-term nominal neutral rate. We do expect then at that point they slow back to 25s, 3 more 25s for next year. And part of that should be because inflation is at least moving in the right direction. So like if you look at core PCE inflation, which the Fed's preferred measure, right now we're running around 5 or 6%. We do think that slows to 4.5% or so by the end of this year. It's certainly not close to target, but it's at least moving in the right direction.
Your call is extreme in terms of what other economists on the street are predicting at this point. But if you watch the market, the bond market at this point, you watch how yields have been moving, maybe it's not that out of step with what investors are kind of already predicting.
Yeah. I mean, I think we were a little bit surprised by the reaction on Friday. But really, I think the market is seeing what we're seeing. And even, in the last 2 weeks since the March FOMC meeting, we've had a shift in rhetoric from the Fed. They're very open to doing larger hikes, to going above neutral. I think the market just needed someone to say it, maybe. And that's the direction we're headed in.
Shepard Smith here. Thanks for watching CNBC on YouTube.